Broad market, S&P coming off its worst four-day losing streak now since October 2008, depths of the financial crisis. Our next guest recommends investors remain more neutral and less on offense. Keith Lerner, Truist Wealth Co-Chief Investment Officer, joins us now. What does that mean, Keith? What are you specifically telling your clients?
That's a little bit old, actually. I'm telling our clients today is a little bit different story. Back in February, we thought there was a lot of complacency in the market. At least now we're starting to discount a little bit of at least a little bit of this, this uncertainty, right? We're down 19% from a high. So what we're telling our clients is that this is time to start thinking more about two-way risk, not just downside risk, but risk to the upside as well. We think ultimately this has, this whole market kind of process will take time. But as I mentioned, back in February, you weren't pricing in really any uncertainty ahead of all this risk. Now you're down 19%. The typical recession is down about 24%. So effectively, you're pricing in more than a 60% chance of recession. You're seeing this market the most oversold that you've seen since October of 2022. And as just one example on the fundamental side, the Mag 7 PE is now at the same level it was when ChatGPT came out in October of 2022. Now, that doesn't mean there's not earnings risk. But again, I think the equation is becoming at least a little bit more favorable than it had been.
So sounds like you're buying, or you're recommending buying or dipping back in, specifically in tech?
Well, we're telling our advisors that, hey, this is going to take some time, volatility clusters, but we would dollar cost average into the market. A lot of portfolios have shifted because of this movement down in equities. Consider rebalancing as well. There's also opportunities for tax loss selling. So there's things to be doing to take advantage of this. And then more specifically, we've been more neutral in tech. But I do think, if you look at some of these companies, you're down now for the S&P tech sector, down to about a 21 PE multiple. Last July, you were in the mid-30s. Again, there's earnings risk. I want to make sure that that's clear. So maybe that PE is somewhat depressed. But these companies aren't going anywhere. They have a lot of cash. And the AI boom, which everyone was talking about 3 months ago, is still alive intact, even though it's not front and center anymore.
Keith, I hear you about the average recession. You get a 24% decline in the S&P 500, but it's been 35 years since we had a recessionary bear market that was less than 35%, right? If you can count COVID, and then you have, the global financial crisis, and then you have 2000 to 2002. So I guess the question is, given the sequencing of things where we went down 19% before earnings estimates started to fall, before we really started getting negative economic numbers, what do you think you would want to prepare clients for psychologically in terms of what we're going to face in terms of news flow from here on the fundamentals?
Yeah, no, it's a fair point. And I think the question, too, is even if we have a recession, is it going to be typical based on this disruption, which is somewhat abnormal, right? So, and I think timing matters because in our view, Mike, is, we've done this very quickly in a linear fashion. So there's certainly a case that we could go even well below that, eventually. But I think in the interim, I think the upside, let's say over the next month or two, is as much, if not more, than the downside at this point. And I do think this market's likely capped on the S&P, call it 54, 5,500. But again, if you've gone through this 19% correction, you are oversold. We're also saying this is, if you can withstand it, this is not the time to panic sell into this, because when we look at those volatility clusters, they tend to, the big down days tend to be followed by the big up days. And over the next 2 weeks following these big down days, you tend to have a minimum rally at some point of about 10%. So I think context is important.
But so you talk a lot about the valuation and positioning, but what about the fundamentals and the fact that we haven't seen any trade deals get negotiated, which was one of the catalysts for the market coming back? The fact that the bonds are now going the other way and selling off. Does any of that make you nervous that there could be further downside, even if you like the valuation story?
Yeah, and when I say valuations, I was talking specifically about tech. The overall market, I would say, is probably, maybe fairly valued. It's not extremely cheap. But yes, all the things you're talking about this morning, all the headlines are negative. Remember, back in February, when we were at 6,000 and above, all the headlines were positive. And at least now, if you get any small piece of good news, even if it's, short term, you'll have a rip in this market. Again, we think for those investors, I guess, on the other side, who are over their skis, have too much equity risk, we would then use that rally potentially to at least trim back towards long-term waiting. So it really depends on where you stand. But again, remember, today, all the headlines are negative. If we get one positive headline, you could see this market move pretty quickly.
All right, Keith. Keith Lerner, thank you for joining us. Truist Wealth, Co-Chief Investment Officer.